Hey there, this is Matt Hultquist, CPA, and I wanted to show you this third video where I continue talking about figuring out where your cash went in your business. The first one was an overview. The second one talked about accounts receivable and how you can make sure that you're collecting money from your customers and spin that cash wheel as fast as possible. And I'm putting these together to help business owners better understand why they may not have cash. It's a common problem I see all the time. Business owners are profitable, they're making money, their income statement is showing that they're making money, but they always say they don't have cash, okay? So these videos are gonna fix this problem and help you understand where did your cash go. All right, so let's get into this. All right, so the problem. We have to first figure out where the leaks are in your business before we can fix them. That other video we talked about accounts receivable. So the second big area of leakage is in inventory. If you have inventory in your business, you are most likely losing a ton of cash because it's not being managed properly. Okay. So obviously inventory is on your balance sheet. This is just the stuff that you sell to your customers. Pretty straightforward. The faster you sell your inventory, the faster you spin the cash wheel that we talked about, and the more cash you will have for growth. Okay. So what this means is that if you have inventory just sitting on the shelf and not selling, you're losing cash. Okay. It's a waste of cash, a waste of money. All right. So how do we figure out how fast you're selling your inventory? That's what you have to figure out. And that's what this video is going to show you, is how quickly you're selling it. Okay. So here's what we have to do. We're going to figure out the inventory leakage. We have to first calculate the average days you hold your inventory. This is an average over all of your inventory. Step one, just like in the previous video, pull up your balance sheet for the last 2 year ends. Step two, pull up your income statement for the most recent year end. Step three, average your ending inventory over the 2 years. This is very simple. Add them together and divide them by 2. Step four, look up your cost of goods sold. That's what COGS stands for. This is on your income statement, and we want to look at this for the most recent year end. Step five, you simply divide the result from step 4 by the result in step 3. And then step 6, divide 365 by the result in step 5. All right, so let's take a look at an example here. Step 1, let's assume inventory was $300,000 and $200,000 at each year end. This is straight from your balance sheet. Step 2, your cost of goods sold for 2017 was $600,000. So we average the inventory. Again, $300,000 plus $200,000 divided by 2 is $250,000. And step 4, as I stated above, in step 2, cost of goods sold was $600,000. So if we divide $600,000 by $250,000, we get 2.4. So then 365 divided by the 2.4 is 152.08 days. All right. And again, I cannot emphasize this enough, but if you are not tracking your inventory correctly on your balance sheet, or you are not tracking your cost of goods sold correctly, which means you have bad accounting or bookkeeping, you cannot determine these amounts and you will not be able to figure out where you're leaking cash. So it is crucial that you have the proper accounting system set up and you are tracking these things correctly. Because a lot of business owners a lot of times say, well, you know, my inventory is about this much, or I think I have this much. Well, you're going to get inaccurate numbers. All right. And so if you don't have cash and you're wondering why, you won't be able to figure out why and where the problems are. And if you don't know where the problems are, you can't fix them. All right. So what this means, on average, it takes you 152.08 days to sell your inventory, meaning it sits on the shelf on average for 152 days. So from the time you purchase it from your suppliers, it sits on the shelf for 152 days. Is this good or bad? Well, of course it depends. Depends on your industry, your history, industry averages of your peers, and how well you manage your inventory. It really depends. So just looking at 152 days doesn't mean a whole lot, but again, it depends on a number of factors. All right, so let's say that this is not good and we want to reduce this number. How do we do this? The first thing that you can do is increase your demand. Okay, well, that's easier said than done, but maybe it's a combination of better advertising, better marketing, maybe a better mix of products. You know, maybe some things that aren't moving become an add-on addition at a lower price when somebody buys something else. You know, I don't know. Again, it depends on your business. Maybe you need to review and adjust your pricing strategy. Maybe some things are overpriced and they should be cheaper. Forecast better. You got to forecast your inventory demand better. This is difficult in new businesses. It takes time and takes data. And but you know, if you can forecast your inventory a little bit better, you can reduce the number and the days that it sits on your shelf. Determine if it makes sense to buy in bulk for discounts. I see a lot of business owners that say, you know what, there are certain break points. So if I buy X number of units, it's this price. But if I buy double the units, I get it at 15% off, and they go for the 15% off. Well, the problem is, you know, that 15% off, that inventory might sit on the shelf for 300 days. Okay, so you really need to figure out, does it make sense to tie up the cash for 300 days to get that extra 15% discount? Oftentimes in a small business, it doesn't make a whole lot of sense. So you got to look at that, examine that. You know, you're losing cash by getting that 15% discount, and the amount of cash that you're losing by having the inventory sit on the shelf for that long most likely far outweighs that 15% discount. All right. So you may have to sacrifice a little bit of margin to increase your cash flow. Discount stagnant inventory. Far too often I see business owners that have things that aren't selling, and they are reluctant to discount it and get rid of it. Move that stuff off the shelf. It's the sunk cost fallacy. You don't want to lose, so you hold on and you hold on and you hold on. Well, you know what? If you need cash, discount that stuff that's just sitting there. You know, get it off the shelf and spin that cash wheel. And then the last thing is optimize the supply chain. You know, I also see this. If you have, you know, if your inventory moves between a couple of different vendors, you know, you need to figure out how to speed that up, optimize that supply chain. Okay. I've seen situations where it takes from the time that, you know, the inventory is ordered, it has to go to 3 vendors, and it takes, you know, 120 days just to get the inventory in-house. And then it takes another 100 days to sell it. I mean, you're looking at, you know, 3/4 of a year from the time you order your inventory till the time that it sells. I mean, that's just crazy. That's a lot of cash out the door that's just sitting there, not even on your shelves. All right. So look at this. So the first thing, accounts receivable, spin that cash wheel. Inventory, move it, get it moving quick, and spin that cash wheel. All right. So the next video, we're going to talk about how long you take to pay your bills and how you can manage cash through your accounts payable. And then the best part is we're going to put this all together and figure out your cash gap, so you can figure out how much am I losing by not managing these items correctly. All right. Hope you enjoyed the video. Hope you learned a little something and I could make this a little simpler to understand. I look forward to doing the next video. We'll see you then.